if you're building a business in the cannabis industry, just focus on serving your consumer. Focus on building a strong foundational company because the rising tide lifts all ships. So don't bet your business on some regulatory reform that you think is going to happen. Build a business for your consumers. And when the regulatory change inevitably happens, the folks with the strongest fundamental businesses will benefit the most.
Hey, everybody. Welcome to episode 127 of High Spirits. I'm Ben Larson, and back with me today is Anna Ray Grabstein. We're recording Tuesday, February 24th, 2026, and we've got a great show for you today. Ooh, a little stutter there. We have a great show for you today. We have Stephen Ernest of Chicago Atlantic on. We're going to talk about how, why, and where capital moves in cannabis, reciprocity and the limited license oligopoly, M&A, ESOPs, and all things cannabis finance. But before we get there, NRA, aloha. How was your trip?
I missed you last week. My
I
trip
know.
I was in Kauai. You were in Maui. I had really no internet at all. I was there. I've been on the board of an organic farming nonprofit called WOOF USA for many years, and every 3 years we do this really intensive board retreat and do a 3-year strategic plan. And that is what was happening. And I actually also
had to be in Hawaii.
It had to be in Hawaii. So we have a bunch of farms that we work with in Hawaii.
Okay.
So that was the excuse for going to Kauai. And I actually just became the president of the board there for the next year.
Congratulations.
Yeah,
Amazing.
which was great. I'm feeling really good about just putting some extra effort this year into making sure that we have farmers, new young farmers coming into the farming space broadly. So fun stuff.
I love that. I love that. I need better boards to be a part of. I don't have any boards taking me to Hawaii.
Oh, I know. It was pretty good. I told my son, he said, "Oh, how was your day?" Because my family came with me on the trip. And I said, "Oh, good. I became the president today." And he said, "Oh, Donald Trump isn't the president anymore?" I said, "Well, no, he's still the president. I'm just the president of this other thing." But yeah, I went to some incredible farms in Hawaii. I saw cacao growing. I saw avocados and mangoes and all these amazing tropical fruits, which was really inspirational. How was your trip?
I love it. It was great. It was great. After we survived the winter storm that rolled through, eventually hitting California and dumping like 10 feet of snow in Tahoe. But we got the preview island style and knocked our power out for 24 hours. But we recovered. It was great. Had a great show with Riley Kirk last week. So that was nice that we got to make that happen and then got the family home. But yeah, we did some surfing, we did some snorkeling, all the typical island stuff. And I'm just excited because I spent a lot of time not in winter this year and I've been enjoying that, and we have a little trip to Miami this week.
That's right. We'll be seeing each other in person for the Canna Bev Summit. Shout out to all the folks making the trip to talk about what's going on in THC beverages and what comes next. It's going to be a great event.
I literally have a unpacked suitcase right here in front of me and another packed suitcase over here going. So, yeah, it's living out of a suitcase recently, but it'll be fun.
Yeah, me too. Well, let's jump into a quick news update so we can start talking to Steve. Why don't you kick us off with what's going on in California?
Oh man, yeah, I got to watch this hearing last week, which was a little disconcerting. We have Assemblyperson Jackie Irwin with the cannabis industry in her crosshairs, and essentially, Jackie Irwin, she's a concerned mom that doesn't think that the cannabis industry is constrained enough, and we all know that the California market is thriving and everywhere, and all that kind of stuff, and it needs more constraints. Joking. if you haven't been listening to the podcast for the last 2 years. Um, anyways, she takes issue with the DCC and them not doing their job, but for some reason she feels like they need to do more rules instead of just enforcing the current rules. And some of those new rules are new packaging requirements, labeling requirements, limiting the dosing of beverages, which famously low dose beverages don't sell very well in dispensaries. So essentially trying to eliminate the beverage category, I guess. I don't know. She just seems to take issue with everything. And the hearing itself sounded a lot like kind of like the Texas hemp hearings. It was very reefer madness. It was talking about all the calls to poison control and all this kind of stuff. And it's a little disconcerting, like with how challenging it's been to operate in California, to know that this outgoing assembly person is trying to make this her last stand. And California has a history of these like Make-A-Wish like grants, where it's like, it's your last term, so you get what you want. All this to say, I don't know how that jives with the governor's last term, and he's been trying to prop up the cannabis industry. So who knows where this all goes, but if you're a cannabis operator in California, get involved and try to do some reasonable lawmaking here this year.
Yeah, it's hard as an operator to keep up with all the changes, and California has been hard, but I will say it also has been getting better for those that are left standing. Like, I talk all the time to more and more groups that are kind of making it work in this market, and there has been a lot of folks that have left the field, but those that are left, I have a lot of confidence in. So, yeah, Jackie or Irwin, go home. No, thank you.
We're
Some
gonna
other
get a whole new batch of legislators next year, and hopefully it's gonna get better, right? It's like hopefully they're younger, hopefully they're more aware of what's happening just with society, and so like we'll have a new governor, we'll have a new majority leader, and we'll have a not Jackie Irwin. So
Yeah. And similarly, just kind of calling out some struggles that are out there. We just saw an announcement that in Michigan, cannabis sales plummeted 8.3% year over year for January sales, amid kind of two big things. One is massive storms, and also the 24% wholesale tax on cannabis. And Michigan had been a pretty bright light overall in the cannabis market, as a mature market, especially, that did over $3 billion and really had like a high per capita dollar amount of cannabis being purchased by consumers. And it's just been a bummer, truly, to see this new tax come, and then things that we can't control, like snowstorms, just really hurt the operators there. So my thoughts are
Yeah.
going out to Michigan today, and same with the whole Northeast, which is also hit with a massive storm. And we know that cannabis is a highly operational business, and people need to get to work physically to, manufacture things, take care of plants, serve customers in dispensaries. And it's really tough with these storms. So just sending out some love to all the operators in the Northeast that are dealing with power outages and customers not walking through their doors, staff stuck at home. It's stuff that's really hard to plan for, and it compounds. So we're sending you the big love, and hopefully some rainbows and sunshine, or at least end to these storms soon.
Yeah, and there's a handful of hemp beverage ladies marching on the Hill today and tomorrow. So Godspeed, and hopefully you're wearing your galoshes.
Yeah, seriously. Well, so let's jump into our interview today. We're joined by Stephen Ernest, a longtime cannabis investor and partner at Chicago Atlantic, one of the most active lenders in the U.S. cannabis industry. Steve has been in the space since 2015, and he has worked at multiple different cannabis banking and investment groups, including Mazzucchelli and Sharp Capital. And prior to cannabis, he managed multi-million dollar, or over $500 million of assets at JP Morgan. So he brings a really great institutional finance experience lens to the emerging cannabis industry, but has over a decade of experience working in cannabis too. He's been at the forefront of cannabis credit markets with Chicago Atlantic, including the firm's recent ESOP deal with illicit cannabis, which was a first to my knowledge of a fully financed ESOP deal, along with lots of big debt deals to MSOs that everybody's heard of, like Verano and MaryMed and others. And they also made a super high profile commitment to the New York Social Equity Investment Fund. Beyond Capital, Steve is also involved in Students for Sensible Drug Policy. So we'll want to hear about that too. But excited to have Steve on the show today. Welcome.
Hello. Thanks for having me. Excited to be here.
Awesome. How's it going today? How's Chicago?
It's great. It's better than my compatriots in the Northeast who I know are dealing with a crazy blizzard. My wife was actually supposed to fly out there yesterday, and she's got an email alert. Sometimes it's like, oh, your flight's been rescheduled. It's like, your flight's been canceled, and we're not rebooking it. So
yes,
yeah, it's great. It's sunny and 35 here, so it's could be worse.
Steve, for the audience's sake, Chicago Atlantic has been notable in the headlines. You guys have deployed a lot of capital, but let's get an understanding first of like, what is the breadth of it? Like, how much capital are we talking about? Like, what kind of deals or what size of deals are you guys doing? And then we'll kind of dive into the nuts and bolts after that.
Yeah. So Chicago Atlantic, I mean, we are one of the most, if not the most active investor in U.S. cannabis. We've deployed over $3 billion into U.S. cannabis since inception. And I head up our originations team. So my job here at the firm is to deploy new capital for the firm. I'd say our average deal is like 30 to 40 million, somewhere in that range. It's we're a bit of a victim of our own success. It's tough for us to do. It's like sub $5 million investments at this point, just because we've deployed so much. So I'd say the bigger the better when it comes to Chicago Atlantic, specifically in the cannabis industry.
Yeah, and the types of deals you do are debt facilities and yeah. Can you explain that a little bit?
Sure.
Just because
So
I'm more familiar with venture and
yeah.
Smaller venture companies. To your point about the size of checks you do, we don't have a lot of debt options, and so it's like you have to get your company to a certain level to kind of really access that level of capital.
Yeah, so we are a credit-oriented investment platform. We're not, as a firm, we don't consider ourselves cannabis investors. We consider ourselves folks who invest where risk is fundamentally mispriced, right? So a lot of the things that we look for are industries or sectors that are shifting from vice to virtue, right? So I think that cannabis it's how we built our firm. Like, we actually started as a cannabis firm. We've since branched out into other investments as well. But the idea is like to protect your downside risk, right? And if you can go into these sectors where access to bank capital is restricted for a variety of reasons, obviously cannabis being federally illegal, we found that you can generate significant alpha for investors, right? If you still hold your underwriting practices, to understand where there is downside risk, right? And collateralizing real estate. We are a publicly traded real estate investment trust, but really what we are underwriting, what we are looking for, is the sustainability of cash flows of a business, right? Because if you buy a building for $10 million and you put $30 million of grow lights and racks and HVAC, right? And the cash flows aren't sustainable, you're gonna have to liquidate that, right? And the value, if it's not working, then it's unlikely someone's gonna come in and value those assets in the same way that you did, right? So a lot of my job is understanding how the capital markets in cannabis work, right? And just because you got the only border play in New Jersey, right? Does that mean that those revenues are going to exist in perpetuity, right? Or you're the first cultivator in a state, right? And understanding, after seeing 40 medical markets and 25 adult use markets mature over the last 10 years, not what it's going to look like now, but through the tenure of the loan of the credit facility, which for us, I'd say our average tenure is about 3 years. So That's how far into my crystal ball I have to look to write a check in this space.
It's really interesting that you're talking about predicting the future, because obviously for debt, of course, you're trying to predict whether somebody can service the facility, and hopefully that you don't have to step in and take ownership over the debt because they couldn't. And so we've talked before about this show. I've joked that pro formas are like financial pornography. Like they really are fantasies a lot of times from operators. And I think that you have to deal with that a little bit. Like I'm sure that you are receiving these pro formas from folks that are predicting their own future. And I'm curious if you could talk about kind of how much you take what an operator tells you their future is going to look like compared to how much you then decide what their future might look like based on your own experience watching the other markets. Like you made an example about Jersey and that border store and what it might do today versus the future, but kind of say more about how you decide whether an operator has the right line of sight on their future or how much you predict their own future for them.
It's a great question because it really is. I think what has made credit sort of the de facto investment vehicle in cannabis is asset managers in general, we're judged on our track record, right? And from a credit perspective, I'm looking at what you have already accomplished, right? You have to come in with a track record, right? We are not funding groups that have like, oh, I've never operated a cannabis business and I won this license, but look at my pro forma. Like to me, that's equity or venture, right? Which is very much about the future, and credit is much more about the past, right? And about the traction that you have, right? So I'm not underwriting a deal based on the future performance. I'm underwriting it on past performance, but I have to understand where the past performance is going to end up through the tenure of the facility, right? So, you could be like, oh, great, I've got a $25 million revenue business and I've got $5 million in EBITDA. But again, if you're early in the maturity cycle of a given state, and I know that competition has not hit your market yet, that I have to be more conservative with that, right? And I certainly want to be using the capital that I invest for EBITDA accretive investments, right? So you better have a plan to say, okay, I'm going to take 5 or 10 million from Chicago Atlantic, but I'm going to take my 5 million in EBITDA and I'm going to go to 10 or 15 million in EBITDA. And somebody like myself who has spent 10 years studying this has to agree that that is going to actually make sense and on the timeline that you're suggesting, which is almost always more flowery than reality. And so, you guys were talking about California a little bit when we started on this call, and I moved out to California. I kind of bet the farm. I was like, I'm going to go out and I'm going to live in California, and California cannabis is going to be king, and they're going to set the culture on this thing, which I still believe. But it was too nascent, right? And now I think what you're seeing in California, to that pro forma conversation, I'm starting to look at pro formas and believe them in California, right? Because you've had so much attrition, and so it's like, okay, well, if you're profitable now and you've been profitable for the last 2 or 3 years in California, I think there's excellent buying opportunities, certainly as a retailer, to go out and consolidate the space. So, part of what we look at is also the operator, right? Like understanding, like I can walk into a store, like you can kind of tell like who's who's operated at retail before and who just was at the right city hall meeting and just won a license and had limited competition, right? So yeah, it's a blend, but I'd say it's especially 10 years in, it's more about historical performance while underwriting the commoditization of the revenue and therefore profitability of a given business.
Yeah. I love that you mentioned the operator because that's a big similarity with venture, right? It's like it's always about like who's operating, and that's who you're investing in, and you're investing in the people.
Sure.
So you mentioned that
all about the operator, right? I mean,
yeah,
that's all you have to go on. So there is no.
So you mentioned the operator, you mentioned the historicals. What's like the third secret filter that most people don't know about, like when they're approaching you? Like what's the big either positive or negative flag that you look for?
I'd say it's funny in capitalism. I think the irony of capitalism is that the less you need or want my money, the more I want to give it to you.
Yeah.
And so, like, if you're like pitching me really, really hard, and you're not understanding, if you're pitching really hard, I'm probably more reluctant to invest in and lean in. The people that I want to invest in are the people who, frankly, don't need my money, but have found a really great, really high ROI opportunity. Right? It's like, okay, I can go consolidate, and I could grow my business by 50% or double my business. Okay, now I don't need the capital, but I have a really attractive opportunity where this capital makes sense. So yeah, I guess almost a reluctance to
Yeah.
want the money.
Yeah, that's funny. I was just reading a post by Ben Kovler because they just took on
Yeah.
a facility, and he's like, if it's not raining, grab an umbrella or something like that.
Yeah, you're right. Yeah. And for Ben, he's got a great balance sheet, and he can, and he's a group that we would love to lend to, right? But he's just been able to achieve cost of capital lower than our structure can tolerate. So, but yeah, that's a good example. And he's big on your beverages too. I know he's.
Yes.
I'm sure you just saw launched at the United Center, which
Yeah.
is not as cool as it sounds in the headline, because they're not.
Uh-oh.
They're not serving at Bulls or Hawks games.
Not yet.
So
Not
I'm
yet.
in Chicago, and that's like, it's probably 2/3 of what goes on at that.
That's the big win. Well, so Steve, tell me, you guys structure your deals as senior secured, which most people know means that, if you don't pay, you're going to get the keys. And so I want to hear more about that, of what that really looks like. And if you could share some experiences of when a deal has gone wrong and kind of what the outcome has been for
Yeah.
Chicago Atlantic and for the business.
Yeah, for sure. Cannabis obviously is a very nascent and choppy industry. So, we are partners with our borrowers, right? I mean, it is, it's always like, this is not a 30-year home mortgage, right? Or I'm going to lend you capital and then I don't think about it again, and maybe until you get refinanced, right? So, we are always working with our operators, and frankly, for me as a sort of the lead originator here at Chicago Atlantic, a lot of the ways that I deploy capital is by finding really accretive ways for my clients to grow, right? So the same mentality is true if it becomes distressed, right? If things don't go the way as planned. I'm working with a group in Ohio right now, kind of on a couple licenses that we lent into. And it just didn't go as well as they thought. There was a couple of covenant trips, and I spent the last week talking to investment bankers and buyers and saying, like, okay, well, let's explore the different routes, out of this option. That's a win-win for everybody involved, right? When you deploy $3 billion into this industry, on one hand, it's not even remotely feasible to be like, oh, I'll just take the keys on everything. It's like, no, like you can't, you wouldn't even have the breath to operate that much. But the flip side of that is you have to be prepared to operate, right? Because not everyone is going to be rational. Not everyone is going to, agree with you. And Ben, as you know, in the venture world, like a lot of these companies are, it's like it's their baby,
Mhm.
and so there's this emotional attachment, right? That not everyone can get out of the way of. So, I'd say when there is a default situation, we're talking to our borrowers very, very early on, and we've gotten so much better. I mean, our underwriting practices just internally at Chicago Atlantic have become so much more holistic. We had a call yesterday just to go over like the sort of distress in the portfolio, right? Like, and when I say distress, I mean, did you trip on a covenant, right? Did you miss your cash covenant last month? Did you miss we call the FCCR covenant, which is a fixed charge coverage ratio, which is basically an indicator of how well that they can service the debt. And when one of those things is tripped, my underwriters tell me, and I'm on the phone immediately with a borrower and saying like, hey, like what's going on, right? And like there's usually a pretty amicable solution out. And my job is to go out there and to these borrowers, like say, I've spent my life researching this industry, investing in this industry. Here are the options as I see it, right? And it's very rare that a borrower is like, you're way off base. That makes no sense, right? They're usually like, yep. At worst, they'll be like, yes to all that. And here's one other option that I have that, you couldn't have known about or weren't thinking about.
Well, you said you have to be prepared to operate.
Yeah.
That's not Stephen Ernst operating, right? Like, have you guys stepped in to operate some of these assets, and what has that been like?
Yeah, so our founder, John Mazarakis, he started his career by building out a 50-chain pizza store on the East Coast. And so I kind of joke, he's like our internal Ray Kroc. He actually is an operator, which is, I think, what helped us be successful early on, right? It wasn't just a bunch of financial minds in here saying like, oh, there's pro forma checks and like, the math works on an Excel spreadsheet. You had an actual operator coming in and saying like, are you serving your consumer, right? Like, are these manufacturing best practices? Are you using data, or are you just going with your gut as to what you think the consumer wants? So we are operators ourselves, and so we have operated. We operate a platform called Vireo, and it is a pathway out for some of the distressed assets that we may find in and outside of the portfolio. So yeah, we are not only investors, but we are operators as well.
That's super interesting. When in talking about kind of the challenges that operators face when things don't go the way they expect, I mean, that's fairly common in the industry. Sometimes it's due to the operator, but let's give them all the benefit of the doubt. And like going back to what you were saying about maturity cycles, they're pretty intense in the cannabis industry, and they vary greatly from state to state. And so I guess, or do they? I don't know. Like, how do you bake that into your predictions, and like how does that kind of like translate to the operators? And I don't know. Are there any states that are actually doing it better than most, or do you just assume the worst and hope for the best?
for sure. I think that the cannabis markets, they lie on a spectrum. On one end of the spectrum, you have markets that are great for the consumer. Think your Californias, your Oregons, your probably even Oklahoma. I'm a little apprehensive to say, but and
that's great for consumers all around the country.
Yeah, exactly. And then there's and it's sort of inversely correlated, right? If the market, and Michigan, right? But if the market is great for a consumer, which means they have access to a ton of competition, a lot of brands at very low prices, it's very difficult on the entrepreneur, right? For all of those same reasons, right? So, historically, I think the investment capital moved into limited license states, and rightfully so, right? Because when you have an unlimited license market, when I was living in California from 2015 to 2020, I keep saying New York in today reminds me of California in 2017, where there's sort of more brands than retailers, right? And when there's more brands than retailers, right? It's very hard to kind of pick a winner and say like who's gonna win this war, right? It takes a while for those groups to kind of separate from the pack. And we have made a couple strong investments on the brand side. Wild and Jeter are two clients that we've built up over the last 3 or 4 years, and they're number one in both of their respective categories. And to your question, are there markets that are better from a regulatory perspective? Absolutely. I mean, I found that the red states in general are more business friendly. They kind of avoid these social equity conversations, which I was very bullish on, and we've been a big part of in New York. We funded the New York Social Equity Program here in Chicago, my home state. Obviously a strong social equity program, and all the way back to California when they did social equity in the Bay Area, right? Geez, that was 2017, 2018, and like
huge failure.
I mean, listen, to me, it's like communism, right? I applaud the idea, and I think the idea was great. But we've tried it a bunch now, and like it just doesn't really work, right?
So let's dig into that, because like that New York deal surprised me when I saw it, because all I could think was like, we've seen this so many times. What in the hell is Chicago Atlantic thinking, backstopping this equity program in New York? And credit to New York, it's actually been better than most markets as far as promoting the equity operators. But yeah,
Yeah.
like, what was the mentality kind of going into that deal?
I got to give credit to our CEO, Peter Sack. That was sort of his brainchild, and I mean, he's one of my favorite humans in the world, and just a brilliant guy. But I think we went in and we said, like, hey, these state governments, and listen, this was 3 or 4 years ago at this point when these conversations started, and we said, hey, these social equity programs seem to be a part of the state legislature or legislative process, right? Most of these states are coming on and saying, you've seen it again in Illinois, you saw it in Maryland, New York. I think most of the blue states do some sort of social equity program. And we thought, okay, this would be great. Like, if anyone is capable of solving this problem, I think it's, we've got as good a shot as anybody. So let's lean in here and try to do, the first private public social equity partnership that we knew of. So it was kind of like an ambitious shot on goal. And ultimately the credit qualities for us on that deal was not the operator, but the state of New York, right? And so, that's what makes that deal tolerable, right? The state said, hey, we want to do this. And we said, okay, you want to do this, like, we will fund it, and you guys will, backstop it up to a certain amount. And that's how we're going to go forth into it. So listen, it's been choppy. It's, I think, probably, like you said, the best social equity program that's happened as far as, like, you actually have seen some of these folks, get equity in it. But I still do question how scalable something like that is. I just, originally we committed 150 million. I don't know if we ever get to that point. I'm not sure that they can scale, enough high quality operators to survive through. And, like, New York is maturing, right? I mean, New York 2 years ago, if you had a license, you probably did okay. In 2 years, less so. It's competitive, like you've seen in California, right? Like, I just, like, you just can't gift a business, right? Like, that's just not how capitalism works. Like, these businesses are extremely difficult to run, even with all of the right people in place, right? The analogy that I give is like being like, oh, hey, Ben didn't have a swimming pool growing up, so we're going to sponsor him to go to the Olympics because he didn't have it, right? And it's like, okay, you can sponsor him, but I don't think he's going to do that well, right?
Hey.
That is very talented.
No, actually, swimming, I'm very weak in swimming.
Yeah, I'm sure he is, right? But, like, when you're going up against, like, the people who are the most qualified, and capitalism has a way of of selecting who is most qualified to drive that value to the consumer. I just think it makes it very difficult to select on any basis outside of who's the most competitive. So yeah.
Well, from a structural perspective, what you guys did in New York isn't the only, like, kind of really interesting and unique outside the box deal that I have heard about you doing. And you recently announced the deal that you did with S1 Enterprises, also known in the market as Illicit Cannabis. And they recently became an ESOP, which is an employee-owned company. And we've talked about this on the show. I've done a bunch of personal research into this for clients who are interested. And it is really unique. And I think, while absolutely different than social equity, it also is kind of putting the future in the hands of people that maybe wouldn't be owners of businesses otherwise, in a pretty cool structural way. And it's been a popular structure for groups like grocery stores that have become employee owned in years past. And usually these deals, basically what happens is a founding team, the owners sell the company to their employees, and the employees, who generally individually don't have the money to buy the whole company, will finance it in some way. And in cannabis, this isn't the first ESOP deal, but it's the first that's been publicly shared that it's had outside financing come in. And generally, ESOP deals have been financed by the sellers, meaning the employees enter into a debt agreement with the owners, the founders often of the company, which means that the founders don't actually get liquidity quickly. It's
Mhm.
like it's a slow drip, which isn't really what they want. And so you guys got involved in this illicit deal, and you came in and you financed the whole thing, which means that now the employees own the company, and they're in a kind of debt deal with you instead of with the original owners, who theoretically get to exit stage left with some cash in their pocket. Is that a good understanding of what happened? Can you tell us a little bit about that deal and how you guys approached it and got involved in it?
Yeah, for sure. So another fun fact about ESOPs is that the most ESOPs in the country are out of Kansas City, and that's where Illicit is headquartered as
Hmm.
well. So there's just a concentration of ESOPs outside of cannabis there. But yeah, I think you're mostly accurate in what you said. The only thing I would say that probably the main difference would be the owners are very much so staying on and staying involved, right? I think you'd have like a same issue of like the social equity issue if you truly just sold your business to like the employees and you were like, we're just going to strip all the leadership out of here, and good luck, bud tenders and cultivators,
Sure.
managing all the corporate side of the business. So, for I think cannabis operators, and listen, ESOP, I think the benefits of ESOP can be most concisely explained in 2 words, which is no tax. So,
Mm-hmm.
if you're and not just 280E, right? No federal, no state tax, right? Because the spirit of an ESOP is the government going out and saying, hey, I want to incentivize business owners to shift ownership to their employee base, right? It's like it's like a social program. So I think that when you look at these cannabis operators, someone who's been doing this now for a decade, it's a lot of fatigue, right? I mean, a lot of these folks, they were 30, 40 when they started. Now they're 40, 50. And like, they just want to go buy a home and like put their kids in like private school, like in like a nice school, right? This isn't like, I'm going to take this giant check and like go hang out on the beach, right? And the ESOP owners, the trade-off is obviously no tax. Obviously, like you could get liquidity as we saw with the illicit ESOP, but there are usually like warrant structures where they can get another bite at the apple. So you're kind of muting your upside a little bit. Where an ESOP an ESOP owner would lose is if there was some watershed moment in cannabis, right? And next year multiples jumped from 4 to 5 times EBITDA to 20 times EBITDA, right? As we kind of saw in like the 17, 18, 19 days, right?
Mhm.
But I don't think anyone thinks that's really on the table right now. And so it's like you take that tax-free growth and you pay down these sellers notes, and then you have like a really strong business. So I think you'll see more of these ESOP transactions happen due to a lack of liquidity options for operators that have been at this game for a long time. And as you guys know and talk on this podcast all the time, it's not for the faint of heart, right?
Mm-mm.
I mean, there's a lot of constant regulatory changes in this business, right? You're living in constant ambiguity. So to even take some chips off the table and say like, okay, I've at least got a nest egg after working in this industry for 10 years as an owner and risking everything and living in complete ambiguity. At least I have some kind of liquidity off the table, to know my family's going to be taken care of.
Well,
I
this
was really excited to see this deal, just on a personal note, because I think that the employees in cannabis have some of the biggest hearts out there. And I
Oh
think
yeah,
even the structure allowing employee ownership is really powerful, and it gets people involved in a way that stock options never really have come to be fruitful for cannabis employees who have been able to get small little pieces of
right.
companies, but then there's just really no exit there. And so this is just another structure. And I think it's really great to see some institutional capital coming in and supporting it. And I think it will lead to more transactions in the future.
Yeah, and like, listen, I think 280E, which I know is talked a lot in our world. I mean, it's punitive, right? I mean, what is the equity value of a business that's paying tax on gross profit,
Mm-hmm.
right?
Mm-hmm.
Not probably not that much, right? So, I think the ESOP actually does two things. It actually does shift ownership into the employees, an ownership that has value, right? Not just stock options. Like, I like joke with my friends in the investing community. I'm like, if you don't own worthless cannabis stock, you have not been in the space that long. Like, it's right. I mean, it's like literally just part of it. I mean, what percentage of cannabis companies, that you could have invested in 8 years ago still you would be in the money on? I mean, like, are there any? I don't know.
Pretty dead portfolio to speak to that one.
Yeah, that's what I'm saying. I mean,
Lots of tears.
the crystal ball. It's like, yeah, and listen, and I think that's also why, the credit side of things has won out from a track record perspective, right? Even if something goes poorly on the credit side, well, at least we invested in something that had demonstrable value outside of a hope and a dream of being the best in class, which is part of my apprehension with the beverage play, right? I'm like, I don't know who's going to be for me to select the winner in a crazy competitive race. And this is coming from someone who's invested in, dozens of early stage companies in cannabis early on from 15 to 20, very, very few of which still exist, right? But if you're writing on past performance, or at least you got, hey, you want a really limited license, and I'm going to put, $20 million into launching 3 or 4 dispensaries and a cultivation. There's at least some value there. And as a debt investor, you're at least, at worst case, you're an equity investor at a lower cost basis, right? Versus if you invested in any equity valuations from, again, 17 to 20, I mean, I wrote a report. I was working with Viridian Capital Advisors. And in 2019, I think it was like February, March of 2019, the Canadian LPs were trading at 100 times trailing revenue. And it's like, I mean, what, you know what I mean? Like, what? You're never getting out, right? There was no path to get out of that ever. But if you're a debt investor, you're like, okay, well, whatever, at least you own whatever, whatever exists. And at the time of underwriting, there was some asset, right? Some hard asset or some revenue and profitability of the business. So you can end up owning something, right?
Yeah. So look, I know you spend a lot of time looking at the past, but we have now mentioned 280E. We've now mentioned regulatory uncertainty, the beverage category, which is largely hemp, I believe you're talking about.
Yeah.
And so 2026 seems like a pretty consequential year. There's a lot of talks around Schedule 3. There is the pending hemp ban with a lot of activity in DC. How are you thinking about this year from a risk assessment basis? What are the impacts if we see some positive movement on, say, Schedule 3?
Yeah, so actually I just wrote this about this in I read our quarterly newsletter to our investors, which I posted on my LinkedIn if anyone cares to read it. But I kind of view it as a shift from a directional headwind to a directional tailwind. I think a lot of folks want to think about this as, again, some switch that you merely flip and everything's okay again. But let's dive into, since I think there's both such big and important topics. Let's do rescheduling first.
Sure.
So we were talking about how long the New York market takes, right, to get from nothing to where it's at today. Like, we're 6 years into the, or whatever, five years plus into the adult use program, and it's a $2 billion, $2 billion market in a market that I think arguably is probably roughly the size of California, right? Maybe it's a 4 or 5, it's halfway there. Schedule 3 is going to take time. It already has taken time, right? When did the HHS come out and recommend that it reschedules? I think it was like October, November of 24, I think, if my memory serves me correctly. And so we are 2+ years down the road from, a major governmental department saying we're going to do this. And then Biden came out and said, do this, and nothing happened. And then Trump came out in November and said, do this, and nothing's happened. So what, the question is, like, what does it actually take? What is the timeline and what is the impact, right, of Schedule 3 on a go-forward basis? And my crystal ball's super fuzzy on this stuff. I mean, I could not have been more wrong on the regulatory side. Like, I think if you would have asked me 10 years ago when I started in this industry when federal legalization was going to happen, I would have thought it was, sooner than I think 10 years into it.
I think I was saying 5 years when I first got in.
Yeah, it was always it was like 5 years perpetually, and then like 7 years into that, people were like, just stop asking me.
Yeah, exactly.
I can't even talk about it anymore. But okay, so for rescheduling, what I think you're going to see is, I do think that when Trump says jump, his cabinet and Congress says how high, right? And so I think there's a demonstrable difference between the Biden administration and the Trump administration as far as like executive orders and like the willpower to actually get things done. The better question, I think, is like, what does it actually mean, and like what is the timeline for that headwind to become a tailwind? And it's not enough for Pam Bondi to come out there and say, hey, we are officially rescheduled, right? If we go from Schedule 1 to Schedule 3 today, right, then the question is, when will the IRS opine on what I consider to be, the majority of the impact of rescheduling is the removal of 280E, right? Outside of that, I mean, yes, research, obviously, acknowledging that it's a medicine, great. I think if it helps more folks get out of prison, or less folks get in trouble for it, I think that's all great. But from a business perspective, 280E going away is really like 75% of the benefit of rescheduling. And so what I think you're going to see is the IRS is going to come out. They're going to opine and say they're going to draw a line in the sand, right? They're going to say anything before this date, 280E get applied. Anything after this date, 280E does not apply, right? And then they're going to have to go and they're going to have to request the money back from all of the companies that have not been paying this, which is almost all of the companies, right? So there's this giant, what we call an uncertain tax position in the space right now. And I think what you're going to see is half the industry has no ability to ever pay that back. The IRS is a for-profit enterprise, right? They're
Last time I had checked, that was like a $1 billion bill. Like, do you know what has it ballooned?
I think it's more than that. I think it's more. Yeah,
because that was like 2 years ago. I think that.
It's multiple billions. Yeah.
It's multiple billions. Yeah, which again is a drop in the bucket from a government spending issue, like $3 billion. Like, pretty sure the national deficit is run on more than that on this call. I don't think it's like a make or break, but I think you'll see the IRS opine. They're going to go to the half of the businesses that have zero capability of paying this back, and they're going to say, well, I'd rather have something than nothing. And they're going to get on a payment plan with them. And then the groups that can't afford to pay it are going to say, you let them pay 50 cents on the dollar. There's precedent for that. I only want to pay 50 cents on the dollar. And then GTI is going to come and say, I already paid my 280 tax. I want a refund because you're not charging these guys the whole, the whole thing. So there's going to be a litigation period on this, right? That I think is going to take years, right? I think from the time Pam Bondi comes out and says we are officially Schedule 3, I think you're talking about a 3-year period where we figure out what this uncertain tax position actually means across the space. And so it's not like there's going to be some flood of institutional capital that's coming in. Let's not forget, Schedule 3 is identically federally illegal as Schedule 1.
There will, however, be a flood of venture and retail capital.
Sure, fine, yeah. I mean, maybe, I don't know. Look at like up to Trump's announcement. It was like markets were up. Trump's announcement, crash. I mean, like even if you had a crystal ball, Ben, if you were like, I'm going to give you the next 2 years of headlines, I still couldn't trade on it. No. I have the Canadian, the CSE and retail investors, like, I mean, I'm done trying to guess that game as far as like how they're going to react to these.
That's true.
To these things. So, I think it's the next few years is figuring out what that uncertain tax position actually means for these companies, which is big, right? But slow, right? It's not like one day you're going to wake up and be like, oh, you don't owe anything anymore. And even if they go and they say, hey, as of 2026, you don't owe anything. They're still going to have a payment plan. And actually there's an interesting detriment that could happen too, where the government says, none of you have been paying 280 at all. You all owed 280E. and now you're on an actual payment plan and you actually have to start paying 280E, even though it doesn't exist in the future. So the balance sheets in the short term could actually be pressured because we're actually talking about 280E and what it actually means for these companies.
Oh my God.
And
Yeah.
you've made investments into companies that have these uncertain tax liabilities, and they're very public about it. They're public companies. So, I mean, so you must feel at some point kind of comfortable enough with the risk that this isn't going to put you in a bad position, that there is a workable solution ahead for, Verano as an example.
100%. So I mean, we include the uncertain tax position as leverage. For us, like we are primed by the U.S. government, and so, there's some companies that have crazy 280 liabilities, like five times, EBITDA 280 liabilities, and like we were not willing to go into those companies, right? But if you're like, hey, I've got one turn of EBITDA of uncertain tax position, okay, well, if I'm going to go invest in it 1.5 to 2 times EBITDA, and you've got this uncertain tax position, well, that's much more tolerable, right? And so we absolutely underwrite for that uncertain tax position in every company, and we include it in their leverage covenant, right? And so you can't just continuously accrue it, in which case you have to have a pretty high margin profile to make that work. So listen, I'm bullish on it. I think it is going to change. I just think it's going to be much slower than people expect and understand, right? You're not like JP Morgan's not coming in because it gets rescheduled. Like it's just the economics aren't quite there.
Yeah. Okay. So I'm already getting anxious on time. I want a part 2 of this conversation at some point in the future, but
No
we
problem.
do have the CannaBev Summit coming later this week, and so Stephen, we had a couple exchanges at the Ignite conference earlier this year or last year. Let's just kind of dive in a little bit. Like, what's your perspective on what's happening? I know you see it as uninvestable from a credit perspective, but there's a lot of hype around it. What do you think's happening this year?
Yeah, there is a lot of hype, and that is just not our investment philosophy here. To invest in the hype cycles.
Hype doesn't pay the bills.
No, that's like very, very venture, which is fine. And like I have like so much respect. I mean, for American capitalism and the venture community. I mean, it's super fun and exciting, and it's the foundation that builds a lot of great industries. Now on the hemp side, for me, I don't see a visible future where hemp, which to me is just cannabis. Like I frankly, like I'm a little annoyed that I've had to talk about this for like 3 years now, like constantly. Like hemp and cannabis are two different things. The joke analogy that I make is if I popped up a table and was selling alcohol across the street from a bar. And I told the cop, I'm like, no, it's not alcohol, it's alcohol. It's fine, right? They would be tased on the street of Chicago if I said that. No one would care. And so I think there's a little bit of intellectual dishonesty out of the hemp side in regards to this being legal and this being talked about and having any sort of framework to grow into. And so, and listen, that being said, like I'm a free the plant person. Like I want to see cannabis everywhere. I think it should be descheduled, right? But it has to be regulated. You cannot mix the honor system and capitalism. And that's what I see hemp as today. So until there is some level of framework where, the adults sit around a table and we talk about this, and it's going to be annoying and there's going to be a lot of stupidity involved, right? But there has to be a pathway, right? There has to be a regulatory pathway that says, hey, like if they come out and they say, which I do think my gut, again, my crystal ball's super fuzzy on this, but my gut says if anything on hemp happens, it is a beverage carve out, right? And if there is a beverage carve out at some level of milligrams, I think it legitimizes cannabis as a whole. We say there is a federally legal, right? Now it's like, now you have to re-question Schedule 3, right? Completely, because you're like, nope, we have a federally legal thing. Like, how is this different? But until that happens, I just don't see a credit product that is appropriate for that space.
Well, stay tuned on that. But I'm going to expect your backing when it does drop.
Yeah, no, my job is to deploy capital, right? Like I would love nothing more than for beverage to be totally legal. If they came out tomorrow and said beverage is completely legal at any milligrams at any store, I'd be like, hallelujah, great. Like that's awesome. I don't think it takes away from the regulated operators on the retail side. I don't think there's a lot of opposition, right? I mean, the retailers in any state, that's not what they're fighting against. They're fighting against someone who's not following any regulatory body whatsoever, saying, I'm going to go buy, let's just call a spade a spade. I'm going to go buy cannabis, right? I'm going to go buy the psychoactive cannabinoid THC, right? Across the street from you, and it's the exact same products at a lower price that's untested, right? I don't think that's A, it's not fair from a business perspective, and B, I don't see it as beneficial to the consumer, right? I don't think consumers should be buying untested products. And again, you can't just be like, I'm doing it right, and so it's okay. Like, you have to have
as it relates to this debate about hemp and Schedule 3 and just federal policy in general, we've seen a lot of infighting in the industry, both kind of within the regulated cannabis space, within the hemp space, and then we've seen even crossover of regulated cannabis operators launching in hemp, less so of hemp operators launching in cannabis, but it's starting to happen. There's folks that play on both sides. Kind of, what's your perspective about this kind of mixed message coming from the industry and how that is potentially kind of harming the path forward for anything to get done? And like, do you have any thoughts on how we can make it more clear of what the industry actually wants or get on the same page together?
Yeah, it's tricky. I mean, I think that people just want to be treated fairly. And like I think there was been a mentality of like, if you can't beat them, join them, right? And I think that for cannabis operators, I mean, especially like in California, a lot of times in California, like there is no pathway to profit. Like you said, Ben, if you're like, oh, I want a 10 milligram, maximum dosage in a beverage and it has to be in a dispensary, like we already have the data on this. We know that doesn't work, right? And so if you're an entrepreneur, like you're like, I'm going to take the risk to do what actually works and serve my consumer, right? And so the hemp loophole was a very natural outlet for that. And I think there's a lot of benefits from that, right? I think that you wouldn't have, Ted Cruz or Mitch McConnell or these Republican senators even talking about cannabis whatsoever, if hemp didn't proliferate across the country. So like, I do think we need to get aligned. Again, as someone who's been in this for 10 years though, unfortunately, the easiest thing for a politician to do is nothing. And so if I'm betting on regulatory change, I am betting on nothing just almost every time at this point, knowing that I'd rather just be wrong the 1 out of 100 times than, right out of the 1 out of 100 times. So I just don't see how hemp in 300 days does something that cannabis has been incapable of doing for 10 years.
Oh, we'll see. Well, Steve, it's come to the end of our hour and it's time for our last call. So I'm going to turn it over to you one last time for advice, call to action, or closing thought to leave the audience with. What do you got?
Yeah, I'd say if you're building a business in the cannabis industry, just focus on serving your consumer. Focus on building a strong foundational company because the rising tide lifts all ships. So don't bet your business on some regulatory reform that you think is going to happen. Build a business for your consumers, and when the regulatory change inevitably happens, the folks with the strongest fundamental businesses will benefit the most. So it's a bit of nihilism, but the good news is there is a lot in your control today, and what happens, tomorrow can only benefit you.
Amen.
Thank you so much. Yeah, great to have you.
Yeah, and all right, Ben, appreciate it so much.
Yeah,
Stephen Ernst, Chicago Atlantic. Thank you for the
around
last
the hoop.
hour. Yeah, man, it's knowledge bombs. Really do want to keep catching up because there's so much more we could talk about. But
Yeah, I want to
that
do a
was-
whole one on hemp. I feel like we need to dive in.
Yeah. Let's
Maybe,
we should probably schedule for April or May. There should be some action by then.
yeah, I'd love that.
All right.
Cool.
We'll talk
Awesome.
soon.
Thank you.
Bye.
All right, everyone. What'd you think? Another great show. Thank you for engaging, for dropping your comments, for liking, subscribing, sharing, doing all the things. Thank you to our friends and family, coworkers at Vertosa and Wolf Meyer, and of course, our producer, Eric Rossetti. If you've enjoyed this podcast, please share it with your friends. Like I said, drop us a review. Really helps us get discovered. As always, folks, stay curious, stay informed, and keep your spirits high. Until next time, bienvenidos, ami ami.